read a second time.
Excellent. Now you can proceed.
Mr. Speaker, I rise before you today with a sense of gratitude and appreciation for the opportunity to speak to this greatly esteemed August House. The Departmental Committee on Finance and National Planning has fulfilled its mandate as outlined in Standing Order 245 by examining and accessing the Finance Bill of 2024. Honorable Speaker, the procedure commenced with a comprehensive briefing on the bill's substance, followed by interactions with diverse stakeholders who share their viewpoints. Subsequently, the committee carefully deliberated upon the stakeholders' comments vis-a-vis the provisions of the bill. Honorable Speaker, I would like to greatly thank the members of the public, and especially the ones who appeared before the departmental committee as stakeholders, the members of the public that came for a public hearing at KICC and gave us very, very insightful views that has improved the report on the Finance Bill of 2024. Honorable Speaker, in a very special way, although these people breached the Data Protection Act by sharing our numbers to Kenyans, but also thanked Kenyans that wrote to us through SMSs, that called us, and some of them, Honorable Speaker, were generous enough to send us 1 shilling and 2 shilling and 10 shillings to confirm whether our numbers were authentic. Honorable Speaker, I have written to the clerk wondering what to do with the 168,000 shillings that have been sent to my M-Pesa, because receiving these gifts from members of the public, Honorable Speaker, is against the laws of this republic. And therefore, later I will be seeking your guidance on what to do with the money, because I tried reversing the 1 shilling and the 2 shilling, and it was impossible, because it came in hundreds of thousands. But for your generosity, Kenyans, I want to thank you and tell you that your views are well received. Mr. Speaker, I would like to draw your attention to an important issue concerning Kenyans' tax revenue collection. Over the past decade, our tax revenue as a share of GDP has remained stagnant at approximately 15%. This stagnation is a cause for concern, and we as a country need to develop favorable tax measures to balance between relying on our own social resource mobilization and depending on debt. Honorable Speaker, this bill proposes to raise a total of 346 billion shillings to support the expenditures that will better be passed by this House through the appropriations bill, Honorable Speaker. Notably, this expenditure is going to lead to the highest allocation ever to county governments at 401 billion shillings. This is the first time, Honorable Speaker, that this allocation to counties through equitable shares is exceeding the 400 billion shillings mark. Honorable Speaker, in as much as this House debates about raising revenue for this country, I want to encourage our members in our sister house, the Senate, and our county assemblies and our county governments to also prioritize ways of raising their own source revenue as county governments. Honorable Speaker, I would specifically want to laud Embu, Murang'a, and Nakuru counties that have exceeded their own source revenue share, because once counties are able to generate their own source revenue, it reduces the pressure that the national government has in collecting revenues to be sent to counties for conduction of county functions through the equitable share. Mr. Speaker, in comparison to African countries, tax revenue as a percentage of GDP, such as Botswana, is at 24%, Mauritius at 18%, and Zambia at 17%. Kenya is lying behind with a tax revenue collection of 14.1% as of 2022. These countries have managed to achieve higher tax revenue collection rates, which highlights the need for us to reassess our tax policies and explore more effective measures that favor the business environment and enhance revenue collection. The Kenyan government has embarked on a tax reform agenda through the medium-term revenue strategies, MTRS, aiming to increase the tax to GDP ratio to 25% by 2030. This reform is crucial for aligning Kenya with its regional peers and ensuring sustainable economic growth through improved domestic resource mobilization. Honorable Speaker, the reason why there is increased debate on taxation in this country is because we have 20% of Kenyans contributing to 80% of our taxes. That means there is a need to have a robust expansion of our tax base and ensure that if everyone in these countries pays their equitable share of taxes, then we will not have to weigh this on the 20% that are paying 80% of our taxes in this country. Mr. Speaker, I would like to highlight a significant aspect of Kenya's economy over the past decade. We have witnessed the emergence of employment opportunities, especially around the digital marketplace. Significantly, this contributing to a significant economic evolution. Furthermore, the majority of jobs created during this period have been in the informal sector. As of 2022, approximately 83.3% of the 19.15 million Kenyans workers have been employed in the informal sector, reflecting the crucial role of the informal sector in our economy. This shows the importance of developing policies and strategies to support and regulate and support this vital segment. Mr. Speaker, the Finance Bill of 2024 had several tax proposals that would enable this country to increase its tax base, especially increasing its revenues. The committee carried out public participation and later deliberated the matters which inform our decisions. For instance, Clause 2 of the Finance Bill of 2024 is expanding the definition of digital content monetization to include all creative work. The committee noted that not all creative works generate income. Therefore, and in order to align with international best practice, it is actually very necessary to specify that only those generating income are subject to tax. Clause 2, Honorable Speaker, is talking about the definition of software, which includes software and royalties in the definition of software and the definition of royalty. To safeguard the interests of distributors in this sector, the committee decided to delete this proviso and exclude the distribution of software from this definition. Honorable Speaker, there has been a notable change in the global arena in tax administration, where governments or parliaments change tax laws to align with court decisions. I think a case in point is the 7Cs case versus KRA in Kenya, where there was the contestation of the definition of royalties to include softwares. And the most popular one globally is the case of the engineering firm in India over the definition of softwares. We appreciate that in as much as it is improvement in our jurisprudence and improvement in our laws to make law process to align with the decisions of courts, we need to be careful not to abuse the power of law legislation to negate the judgments made by our courts. Clause 4, Honorable Speaker, proposes to reduce the period for claiming deferred realized foreign exchange losses from 5 years to 3 years. The committee supports retaining the current period, allowing businesses to recover foreign exchange losses over 5 years instead of the proposed 3 years, especially during these times of uncertainties in the global market, and especially including the de-dollarization of the markets. For example, we have seen some of our global leaders backing their currencies through gold and not through, for example, the most popular used currencies such as the US dollar. Clause 6B2, Honorable Speaker, proposes to exempt reimbursement of expenses incurred for asset purchasing during official duties by public officers, which was extensively discussed with stakeholders. The committee ultimately decided to remove this amendment that aimed to exclude public officers from taxation on employment of benefits received as reimbursements for asset acquisition. This decision was driven by concerns by members of the public that such exemption would unfairly discriminate against private sector employees and could potentially be abused. As framed on the bill, Honorable Speaker, there is no definition of what these assets are. And therefore, we stand a risk of having public officers buy houses or buy factories, and those factories or houses that they buy from taxpayers' money will not be subject to tax. So the best way would have been to treat the same for public officers, the same with private officers. But Honorable Speaker, if we allow private officers to be exempted from tax on payments made to them for assets, you might find officers being paid in terms of assets just for tax planning and tax